What's up, guys? Sean Emory, Avory Company, investing where the world is headed. Today, we're talking about Fiverr. They just reported yesterday, the stock was up roughly like 20%, its best day since April of 2020. That's the good news. The question is maybe why did it react the way it did? Some could say there was some short interest, so you're getting some, short covering based on the fact that number one, they laid out a plan for $300 million in cumulative cash flow over the next 3 years. And the fact that GAAP and non-GAAP are converging as their 2021 stock-based comp kind of plans that they had in place then are starting to lap. So less and less of the free cash flow is coming from stock-based comp add back. So that should be welcomed, by the market. The second big thing is that they announced the deal of AutoDS, and I just got off the call with management. They were all there just now, a second ago, and that's why I'm trying to talk to you now while it's still fresh. So AutoDS is one of the leading software players and integrators for dropshippers, basically those that sell products. They don't necessarily own or store the products. They essentially go and create websites, create marketing materials, and try to sell products that then once they're purchased, they are delivered from essentially a manufacturer, across the globe, and delivered directly to, that customer's door. So it's really a asset light model for, individuals or, small businesses that are drop shipping. So the story there is that, they probably paid somewhere around $10 million for this asset. From what we can tell, they did something like $7 million in revenue in 2023, growing around 40+%. Obviously, that outstrips most of the market in terms of growth. Drop shipping more broadly has been a category that has succeeded over the years, and it's really been a category that's been around for a while. The question, though, and I posed to management, was really around synergies of AutoDS to the core business, and the explanation from Mika on the earnings call and then, post call as well was really around that, the team, seemingly it seemed like the valuation, even though, that's not, disclosed, the fact that they sought out categories that are on their platforms that have, growth elements to them and, are big enough to make a difference. They highlighted that there's roughly, 150,000 drop shippers of sorts using, Fiverr. And, that's a big deal. That means, quite a big category, broadly speaking. For now, the plan is to keep, the two companies separate. And, naturally over time, they've done this with other acquisitions, is migrate these together. Now, the importance of this are the synergies between, the users that are using drop shipping functionality or Fiverr for drop shipping, capabilities. And then also to the core Fiverr business is the reoccurring business. On the earnings call, and I'll just, elaborate a little bit of not only why we think, the stock reacted, but, for the quarter, and I'll bring up some of the figures here, is essentially, they finished the quarter with $94.7 million of revenue for the quarter. That was above the midpoint of their guidance. Same with their cash flow of 17.8, above the midpoint of the guidance. That implied an EBITDA margin of 18.9%, which is a record for them. They suggested or had a guidance that was elevated at the low end, and now suggest $383 million to 387 from 381. So a $2 million raise at the bottom end of their prior guidance, and another $2 million raise at the bottom end of their EBITDA guidance as well. So number one, you had this acquisition of AutoDS. Number two, they laid out a groundwork for the next 3 years in terms of what they expect to generate in cash flow, $300 million. And that also implies a 25% margin. We question them in terms of the cadence of that margin trajectory. And, it's likely to be much more steady than lumpy. Two questions that we had for the team was really around active buyers. what's happening there. Is there any sort of like, geography trends? Is there any sort of trends around implications of AI? And not really anything that was, I think pointed that answers that question, which probably is a good thing when when it's all said and done. Now, keep in mind when you think of active buyers, you compare that to things like temp workers. If you look at like Robert Half, which does revenue generally related for temp work, they've had their revenues decline for roughly like 6 to 8 quarters in a row, while someone like Fiverr, who is a marketplace for talent, has actually seen revenues increase over that same time frame. You have job openings, and then job openings within software down 17%, down 6% for the overall index. And ultimately what that suggests is the demand for just talent more broadly, whether temp work like Robert Half, whether it's job openings for all industries, whether it's technology demand with the software related job openings, all of those are down anywhere from high double digits or high single digits to double digits, and all while Fiverr has generated returns. Now, what we love during this quarter is that they actually broke out that they their take rate. So there's always been this debate, not internally as much as external, when we hear people talk about Fiverr increased their take rate. The fact is that their take rate today is roughly around 33%. That's where it finished this past quarter, up 2.3% year over year. So that's a good number. Now, some will question, how high can take rate go? And, they smartly broke out, core marketplace take rate, which is the take rate that the customer and the buyer pay. That honestly hasn't even moved anywhere really over the last, 5 to 10 years. Very minimal, maybe 1% or 2% here. But really a lot of the additional take rate has come from value-added services, which are more transactional, service-based take rates. So everything from promoted gigs to Seller Plus. These are subscription services for sellers. These are ads that sellers run on the platform. Both of those, management said, are still in, not widespread across all sellers. And, the landscape or ad load for promoted gigs remains, pretty open in terms of opportunities. So the acquisition recently should add to that kind of non-core service take rate into the future as well, and add more reoccurring business. So again, the breakout of core take rate and service kind of value added take rate, I think, was an important distinction, so that people can understand that actually Fiverr's not taking more money of each transaction. In reality, they're providing additional services that people are paying for and are much more reoccurring in nature. So that's kind of, much of the main points of this last earnings. The last thing I wanted to highlight was obviously they guided and increased the bottom end of the guide, and that incorporated some of the commentary around volatility they saw in June and July, mostly around buyer behavior. And I think that's important because, they highlighted how, they want to essentially surpass obviously their own guidance, but doing so in a prudent way. That's how they historically have guided the street. And so while there was volatility in the quarter, it sounds like spend per buyer, which was up 10%. I didn't cover that a second ago, but spend per buyer is the amount of dollars people are spending. So as they continue to move up market in this environment, instead of trying to go after small buyers, they're going after higher value buyers, and that's showing up in spend per buyer up double digits. They expect that to continue, which again further illustrates what they've been talking about over the last couple years. So again, you have a company that has $700 million of cash, $400 million in a preferred note that's generally has zero interest on it. This was issued back during 2020, 2021. And it expires in November of 2025. So they have about a year to figure that out, but they have $700 million of cash. They're generating, close to, $70 to $100 million in free cash flow, depending on, where things head. They've guided to $300 million in cumulative cash flow over the next 3 years. They've already spent through the $100 million buyback. So they're sitting financially, balance sheet wise, in a really sound place. And then lastly, again, as rates potentially come down, over the next year, that should buoy, some of the job demand in the market and be a catalyst for someone like Fiverr. I'll end there. I guess last point that I did want to highlight is they highlighted how AI, a category like translation and writing actually, saw a sequential improvement of 10% year over year. That's super important because, there's been this, discussion around Fiverr being impacted by AI, yet they've, to some degree seen some stabilization in probably the most sensitive categories to AI, while also seeing their complex and AI related services improve the overall marketplace. So at 6.5, 7 times cash flow, stock-based comp coming in line with GAAP, a lining up of $300 million in cumulative cash flow over the next 3 years, an acquisition, that we'll see how that transpires over time, but interesting approach of going after some of your largest audience. I think a lot of that is positive. We'll wait another quarter, and at that point in time, we could be talking about an entirely new rate environment. So with that, we'll have other postmortems after this on other companies, but we'll end there. So have a good one.